Why pay more for your precious metals from the big guys with offices on Wall Street and who bank with JP Morgan? Get your fizz from the doc at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, joining us this week is a special guest. Silver Doctor's readers and listeners will be well familiar with him as a contributor to Silver Doctors, but first time joining the show, Steve St. Angelo of the SRSRocco Report, expert on gold, silver, and particularly oil. So thanks for joining us today, Steve.
Yeah, great. It's good to be here, Doc, and I have to say the site looks really good. Really like the new site, and it loads fast.
Thanks, Steve. We're recording this Thursday afternoon after the markets close here this week, a little bit early this week, so we don't have the jobs report, the BLBS in yet from Friday morning, but here on Thursday, just a continuation of the gold and silver raid that began really on Tuesday when the markets came back from the holiday. Silver trading, they pushed it almost down to $19 now. Right now, closing the access market here right around $19.10. And gold also pushed well under the $12.80 support level. It was trading around overnight on Wednesday here, down towards the $12.60 level. We'll start with you here, Steve. What's your take on the latest raid in gold and silver and what we're looking at here in the short-term markets as far as the metals?
Well, Doc, it seems to be the same old thing. I guess a lot of precious metal investors, are becoming, quite used to a complacent. And, it's look at the dollar. Gosh, it's almost up. Well, I think the last time I checked, it was up 90 basis points, 90 points. And so this seems to be business as usual. In the short term, it looks like we may see the same thing. And again, I try to stay away from short-term forecasting because it's almost impossible to get an idea of what things are going to happen when the market's, as we all know, totally rigged. It's interesting that again on the Shanghai, I know we'll talk about this later, but we had another 2 metric tons taken off today, and it's down to a low of 94 metric tons. And the COMEX, they're still kind of building a little bit slowly, but as we know, the COMEX is more of a paper exchange, and Shanghai is a physical exchange where you actually, it's more of a delivery mechanism. So again, it seems like in the short term, prices are going to be weak. We may see a little pullback and a reversal here, but I don't see much of a change here in the immediate future.
Steve, one other quick question here. What's your take on those COMEX numbers? I know Jim Sinclair has advocated that you really take them with at most a grain of salt, as the banks lie about anything. What makes us think they should be telling the truth about their inventory levels in gold and silver? Do you hold that opinion as well?
Yeah, let me qualify that. We do not know the exact figures in the COMEX. We can't. I mean, if they can manipulate the LIBOR, they can manipulate figures. It's very simple. There's really no open and honest reporting or looking at the vault, auditing the vaults to see exactly what's there. So we just go by their figures, but it's the best we have. It was interesting, back in 2011, the inventories were falling pretty good. They were falling pretty good. Matter of fact, we had a pretty good low there in June. I think it was 2011. The COMEX silver hit the all-time low. So do we know if all that silver's there, how much of that silver's there, and how much of it is maybe oversubscribed? We don't know that, but I would say there may be some sense to the figures. I think the COMEX figures, even though they've grown a little bit, they haven't changed all that much in the last several months. So that's the best way you can put it. You can't really say whether the figures are manipulated or not because we don't know, but I don't see much change. Let's just put it that way.
What we do know is that the commitment of traders' numbers are reported by the bullion banks themselves, and it's almost a foregone conclusion to say that we can't take the numbers at face value when J.P. Morgan is reporting them to the COMEX, and the COMEX says, here we are, this is what we see. And then, of course, the vaulting and other issues that you described give plenty of reason to take grand skepticism with them.
And then the recent disclaimer that was added, about a year and a half ago,
right.
The legal disclaimer saying that they're not necessarily valid or accurate. Well, Eric, this question would be a bit easier to answer if we were recording this show on Friday. But what's your take on the metals here? The last few months, the week leading up to the jobs report, the metals have really been hit hard. And then counter to what we've seen over the past 10 years, they've actually spiked up after the jobs report, with silver today on Thursday breaking down below what's been pretty strong support in the 1940 area. What's your overall take on the market here? Do you think we're going to see silver continue to break down and possibly retest the lows in the 18 to 1850 zone? Or is it going to be what we've seen recently of a move up off of the lows leading up to the jobs report and then rally into next week?
Well, it's really hard to say what's going to happen on a day-to-day basis, but backing up to a slightly easier question to address, I do believe that the lows in the 1850 area that you're speaking of will hold if we go down there. And there's a pretty decent chance we will, because you can see even in the action today, the central bank in the European Union, ECB, has talked about lowering interest rates to 0.1% and practically zero, and what would normally be considered economically a bullish stance for gold because of the move in the dollar moving higher versus the euro, and then also what I believe were cartel footprints that you can see today. The cartel is active. They're managing prices lower. This happens almost all the time historically whenever there are geopolitical tensions in the air, and at this stage, there's very aggressive buying on COMEX with people positioning in the silver markets and rolling over those contracts. Open interest keeps growing in silver space. Gold is a different picture, but it looks like that there may be some, like a Mexican standoff in the silver market when it comes to paper contracts, and we've talked about that before in other shows, principally when Bill Murphy was on. So anyway, the bottom line is that it looks like we'll probably stay here because of the China put, so to speak, and because of the demand that's coming out of Russia and China and Asia and the Middle East, generically speaking, because physical supplies and the limitations of the cartel and their ability to raid inventories out of GLD and other exchange products and the COMEX warehouses and so forth, and central bank gold being diminished after all of the shenanigans of 2013, on and on and on. There's only so much that the cartel can do, and given the fact that there is this sustained level of demand, the markets will continue to get a base. Anytime it dives a lot, people step up to the plate and buy. I mean, even the World Gold Council this week declared that Indian smuggling demand was 200 metric tons for this year. I mean, when we first reported on this back in May of 2013, you'll recall, that was the exact number I figured would be the annual run rate. So, people are catching up to the fact that this Asian demand juggernaut is not going away, even if they try to kill it with taxes and import restrictions and other means of curtailing Indian demand. So that's really the bottom line. And the jobs number will be interesting. Having fallen a lot today, I think there's a possibility that we will stabilize and not see even further carnage tomorrow, because that has happened many a time when the cartel has aggressively attacked gold and silver in advance of a jobs number. But it really is hard to say. I don't have a firm read on what will happen tomorrow and in the very near term, other than the fact that I don't think we're going to see much more downside.
And we have seen really the sleeping giant awaken and retail gold and silver demand here this week. An interesting anecdote here. In the wholesale and retail market here in the U.S. completely dried up in the last 2 days for gold coins that are not current year, meaning that anything that's on the secondary market that has been previously owned, it's all gone. It's not available. It hasn't reached a shortage yet that all the current year coins are unavailable. And as Steve, you've been well documenting recently, particularly in gold, the U.S. Mint sales have been off markedly in 2014 from last year in 2013. But we did, anecdotally, from the supply in the backdated market or secondary market, from all the coins from previous years that are on the market, they've vanished in the last 48 hours. The market's completely wiped out, and only current year product is available. So I wanted to talk a little bit more here, Steve, about that, what you've been seeing in the physical demand here, both in the U.S. and in Canada, in the North America, as well as we were discussing here before we started recording, the unprecedented silver takedown that we continue to see in Shanghai.
Yeah, well, that's interesting that you said that you're seeing that the wholesale demand has just wiped out all those older dated coins. And it's interesting that if you look at just the first half year of 2014, when we look at silver eagles and silver maples together, they actually were higher. And of course, it was stronger up till June. But from my figures, silver eagle and silver maple sales were 39.5 million from January to June. Last year they were 39.5 million January to June this year, and they were only 39 million last year. So they're up 500,000. Now it's not a lot, but it's 1%. Now let's compare that to the gold eagles and maples. They are down 707,000 ounces, and that is actually a fall of 54% year over year for the first half. So it's interesting to see, even though gold is down, gold demand is down, silver eagles and silver demand it was still quite strong. And I get readers on my site telling me, well, you shouldn't really be going by the physical market, by gold eagles or silver eagles or maples. That's not really indicative of the market. And interestingly, I think maybe you've touched on this in past podcasts, but the World Gold Council, they got it right. They showed that official gold sales for official coins were down 50%, and that's all of them for the first half of the year. So, and then you look at jewelry demand was down 30%, and I think gold bar demand, physical bar demand, retail bar demand was down 57% in the first half of the year. So, I mean, it's kind of indicative. The gold eagle market does kind of correspond to what's happening. And I think it's the complacency of the market. The investors they've become complacent. And of course, they're coming off of a huge, a rock bottom sale last year. So we had very high demand for the first half of the year. But that's how I see it. So that takeaway, Doc, is silver investors are still remaining quite strong. And I think the rest of the year, we can't tell. I don't think it's going to be as strong as the beginning of the year. And right now, I think you had 2 million, a little more than 2 million sales of the silver eagles in July. So I don't think we're going to see a real strong end of year unless we have something interesting happens in the world, a big geopolitical or black swan event. It'll be, I think you'll see 2 million. You might see 2.5, 3 million some months, but it won't be as strong as the first half. And again, as I stated in the beginning of the interview, another 2 metric tons were taking off the Shanghai Silver Exchange, the Shanghai Exchange. And so at the beginning of July, there was 234 metric tons on the exchange. And the beginning of August, it was 148. And now it's 94. So it seems like this rate, if they keep removing the silver, we may get down to bottom basement levels here in just a month or so. And I don't know what that means. And I emailed Turd a question to see what Andrew McGuire thought of this. And he told me and responded that Andrew had been meeting with a couple of his Asian clients, and he said it was a big deal. it meant it was a big deal, and I haven't heard back from him yet. So I was looking forward to see what he had to say about it. So hopefully Andy McGuire may give us an update here soon about that. But I don't know. It's interesting. Nothing seems to be happening on the COMEX, but boy, the silver just keeps coming off the Shanghai. Isn't that something else?
Yeah, and they're going to supposedly turn on the the Shanghai exchange for physical settlement on the 26th, even for export out of China. So how do you run a physical exchange when you have 90+% of your inventory of silver decline in 18 months? I mean, there's just something really strange going on there. It'll probably create another source for a floor in the price of silver, if not to contribute to higher prices soon.
Yeah, let me say one more thing. I'm a firm believer in gold and silver, and have been since I bought my first ounce in 2002. And I remember sending that check and getting it for $4.52 an ounce. And so I haven't changed my mind. I've been through the ups and downs. We all have. And this has been a much longer process. And I think it's been done on purpose, of course, to make sure everything goes into the dollar and the treasuries, and of course the retirement system. And I had a recent article that the U.S. retirement market is now $23 trillion, up from $22.7 trillion in the fourth quarter of 2013. And so the U.S. government, the Fed, has to prop up where most people have their assets, and it's in the retirement market. And so we're going to see this continue. I don't know how much longer, but I'll tell you what, I believe gold and silver, especially silver, is that you can't spend your fiat money on a better deal right now. I really believe that. And I think at some point in time, you just won't be able to get the silver eagles. I don't know when that's going to happen, but it will happen.
Yeah, one of the underpinnings to that fact and reality is the understanding of peak oil. And the amount of energy that it takes to extract metals out of the ground is substantial. It's the biggest cost involved with any mining operation. And that is you've done a lot of work on exposing the relation between silver and gold and energy prices. And I wonder if you can speak to that a bit and share your insights with our audience.
Okay. That's what I try to do at the SRSRocco report site. I try to look how energy is going to impact the precious metals, the mining industry, and the overall economy. And there's a lot of analysis about the gold-silver ratio. And most of us who have been following the precious metals know that the gold-silver ratio was about 15 to 1 for a long period of time. Kind of fluctuated, but up until the 1800s, it was like 15 to 1. And I believe, according to my analysis, is that was based upon how it was extracted out of the earth, and that was done by human and animal labor. So when it was extracted at about the value of its ratio in the ground. So that's why we see that 10 to 1, 15 to 1 kind of ratio. Now that we had the advent of the industrial age, and then oil came on the market, especially in a big way in the 1900s. We had all these oil slaves. I mean, it's amazing how much energy is in a barrel of oil. And so what happened is it changed the way the mining industry mined. And so we could mine base metals much greater, and we can pull out base metals much more at a much higher volume. And so it changed that gold to silver ratio to what it used to be 15 to 1. Now it's 66 to 1. And if you look at a break even of gold, and I estimate it's about $1,300, give or take. And then the break even for silver is about $20. That's not a sustainable price. That's maybe about now. And if you divide those, you get 65 to 1. Now, it is primary mining, but that's how I see the computers are pricing silver. They're pricing it on its production cost ratio. And that is not silver and gold's value. Silver and gold's value is based upon its economic energy. And as I've said in many of my articles, peak oil will destroy the valuation of most paper assets. Now, I know a lot of some of your readers and some of your listeners may not believe in peak oil, and I'm not going to debate that issue. And that's a whole other topic for a whole other day. But the financial industry and the energy industry are codependent. If one goes down, it takes down the other. And so once that occurs, you lose this expensive oil that we're producing, like shale and tar sands and deep water. It becomes, if there's a deflation, it becomes too expensive to produce that oil. And so what happens is you lose a good bit of that production, and it may never come back. It may never come back. And so what happens is you get this kind of cascading reaction. And what happens in the markets? People look and they go, well, if we're not going to have a growing energy supply, and Nike is not going to continue growing its sneaker sales, then its stock isn't worth this anymore. And so the net present value of all these assets just implodes. And that is when the values of gold and silver, I'm not saying it'll occur just then, but that is the time the values of gold and silver will actually hit their fundamental value. And so let me conclude this by saying there's a misunderstanding that some of my readers or some people think that the rising cost of energy will increase the cost of production for gold and silver, so that is what's going to make the price of gold and silver go higher. I don't believe that. We may see a slow increase in the price of energy or the price of the cost to produce these metals, but I don't think the price of oil will rise that much. And that's another topic, because at a certain level, and I think it's 120 a barrel, then economic activity just crashes. So there's a new thing, Steve Koptis put this presentation out recently called the supply constraint model. And the oil majors have finally woken up. They realize the public will not pay 120, 130 for oil. So they're cutting back on capital expenditures, they're cutting back on exploration, they're selling assets because they need to make the shareholders happy. They need to show cash flow. And they're not really making money because the margins are falling, because it just costs more money now to produce this oil. So we're not going to see 130 and 150 and $200 oil. Now, we could see that price if everything is inflated, but we're not going to see a much higher price of oil compared to other things. It won't happen because the market can't afford it. So that's how we actually peak. We peak because the world can't afford the expensive oil, which is the reason why I believe the precious metals are the best assets to own in the future, because everything else will be falling in value. So that's my theme there, Doc.
That's interesting. I'll have to look into that study because, having done 20 years of study of peak oil, I wouldn't agree with that thesis. I mean, we do have demand destruction, and prices have kind of like an oscillation to them where they dive back down anytime we have a spike. But if one subscribes fully to the thesis that the flow rates of oil and the energy return on energy invested as principal concepts within peak oil are the most important things, you'll eventually get to a point where there is lower availability of oil at X, Y, and Z price levels, demanding higher price levels to pull it out of the ground because of just the fact that easy to tap and exploit reservoirs become harder and harder to find. So just as a side note, I mean, maybe we might want to even talk a little bit about just the basics of peak oil and explain it for people. I know you somewhat punted on that earlier, but if we got the time, it might be a productive conversation because there is a lot of misunderstandings about peak oil out in the marketplace of ideas. And, the fact is that the world production of conventional petroleum did peak at 75 million barrels production per day at 2005. And the only difference has been made up with unconventional natural gas liquids, tar sands, additions of ethanol to the gasoline stock in the United States, and so forth. And people speak about peak oil as if it's a theory, but it's as substantiated as the theory that the Earth revolves around the sun. The data shows it. It's not really open for debate, and it's really a question of prices continuing to have an upwards trajectory based on the fact that it's becoming more difficult to get oil. I mean, the whole shale boom is a perfect example. That's very expensive oil, and we're only going after it precisely because easier to obtain oil has been tapped more so than 20 years ago. So if you'd like to flesh out some of the basics of peak oil, I think people would appreciate that.
Well, you hit it pretty good. And basically, peak oil is like anything else. I mean, you exploit the resources, and you keep producing them. They peak, and then they decline. And King Hubbard actually forecasted in 1953 the U.S. would peak in 1970 at about 10 million barrels, and we did. Now, he didn't see the shale revolution. He didn't see the tar sands. And I would suggest that if we were on a real gold standard, you couldn't afford tar sands and shale oil. The only reason why the world can afford tar sands and shale oil is because the Fed and the central banks are propping up the market with debt. And so if we were on a gold standard, I think peak oil would have come and gone already. That's how I see it. But just to give a quick understanding why I believe there's peak oil, you go by the numbers. The numbers tell everything. The data says it. It's not a matter of me believing it or not. And in 1930, and I've said this on my site, that the U.S. was producing 100 barrels of oil for every barrel it cost in energy. And in 1970, it fell to 30 to 1. And now I think it's about 10 to 1, the average is. We still import a lot of oil, and we still import high ROI oil, energy return on invested. But shale is 5 to 1. And so once you start getting down to 5 to 1, it becomes much more difficult to sustain our modern lifestyle. And Charles Hall, who just retired, he was one of the bright minds on the study of the EROI. He says that a minimum EROI for a modern society to sustain itself, I think it's about 10 to 1, at least 10 to 1, to have healthcare, entertainment, the transportation industry, the infrastructure, education. If you want to have that, you have to have 10 to 1. So tar sands and shale don't pay for it. Now, they're supplementing the oil production. They're doing that, but they do not pay the bills that we need to run a modern society. So we're hitting the peak of oil production now, even though we're getting, as Eric said it, we're throwing in a lot of natural gas plant liquids. And that has about 60% the energy of a barrel of oil. And it's priced at much less than a barrel of oil. So we're using a lot of stuff to kind of fill in the gap and make things kind of continue forward. But I would say there's some good forecasts that the Bakken will probably peak. The Bakken oil field in North Dakota will probably peak within a year, give or take. And then the Eagle Ford isn't too far after that. So once this occurs and once the world realizes that this isn't going to make the U.S. energy independent, wish it would, but it won't, then you start seeing a whole different picture. So I see the manipulation of the precious metals. I see the propping up of the broader stock markets, the U.S. Treasury, the dollar. I see that coming under extreme stress as the oil starts to peak and decline. So even though it's another year or so off, you can't fool the market if you don't have the energy to keep growing. You can fool it with inflation, but you can't fool it with a falling oil supply.
Now, as we were discussing before we started the show here today, Steve, you don't necessarily agree with other financial experts like, for example, Jim Sinclair, who expect after this coming collapse that will return to a level of high economic growth and prosperity, do you?
No, and listen, I respect Jim Sinclair. There's nobody in the precious metal community that hasn't been following him, and he was one of the top traders in the 1980s. So I give him a lot of respect, and I just spent a lot of my time looking into the energy aspect, and so it doesn't matter if you back the dollar, the 17 trillion of debt with gold. It doesn't matter if you back everything with gold, because energy drives the economy. Energy drives the markets. A farmer cannot drive his tractor on a natural gas contract, and a manufacturing plant cannot produce its equipment or produce its products with an electric derivative contract. It needs electricity, and the farmer needs diesel. You need energy. And so, unfortunately, I see that when this next collapse comes, it's one that we don't come out of. And I don't want to seem too pessimistic. There are ways to transition to something else, but it's not going to be business as usual. It's not going to be growth forever. It's not going to be suburbs and Starbucks, and it's going to be a whole different situation. So, no, I disagree. I do believe the value of gold and silver will increase compared relatively to everything else. But I do not see a return to good times. I just see us muddling through this thing, and a disintegration of basically of our modern society into something more sustainable.
All right. Well, before we wrap up, anything else either of you want to discuss?
Should probably put in a footnote about what's going on geopolitically. We have NATO meeting in Europe to talk about what's going on in Ukraine, and earlier this week we had the interesting story where Poroshenko, the president of Ukraine, said, we have a peace agreement. I should back up, not a peace agreement, but a ceasefire in the eastern provinces, and Russia's acquiescing. And then Putin came back and said, hey, wait a minute, we're not officially agreeing to that terminology because we're not actively involved with this conflict. And it's separatists within the eastern Ukraine. So that was a rather amusing swap of news headlines earlier in the week. And at this stage, it looks like the whole pattern of the West continuing to basically try to agitate and further raise tensions is continuing. Last week we had the whole, Russia has invaded card played once again, and this is, by my count, the 5th time that the West has claimed that Russia has invaded the Ukraine. It's unfortunate, but there are a lot of interests that are geared up and looking to maintain a level of tension to basically ring fence Russia and China and compete with them geopolitically and preserve the dollar and deal with the natural gas pipeline flow to the European Union as well. I mean, basically, I think that this conflict has an end point that's defined by the coming winter. With Russia supplying 40% of the gas to Europe, there really is no reasonable expectation that sanctions can continue and that this conflict will continue unless if it goes hot and there's an actual war, because in all other scenarios we're basically looking at the European Union facing a crisis in the winter where people will literally die because they won't be able to heat their houses. So even though it's been really turbulent over the course of this year, if I had to say what will probably happen later, there will be some kind of a resolution to this crisis. And hopefully the militarists in the West in particular will not seek to circumvent that, but time will tell.
So hopefully Eric's right that this Ukrainian and Russian crisis will be resolved here before the winter. So just to kind of wrap up here, Steve, we have you're expecting Bakken and Eagle Ford to peak within I think you said the next year?
Oh, yeah, the Bakken to peak probably within next year. It looks like it, and then the Eagle Ford not too soon afterwards.
And I can't say that I can argue with your thesis too much here that we really won't come out of the collapse that's coming, at least in terms to what most of our listeners have become accustomed to in modern America. Hopefully, Steve and I will be wrong, but I don't know if it'll be pretty.
Yeah, it's we've enjoyed, especially Americans have enjoyed a standard of living, and it's been a nice run. The Romans, they enjoyed a standard of living for centuries, and it was a nice run. And I'm not saying it's the end of the world. I'm just saying things are going to be a lot different. And so it's how we change, it's how we transition due to a peak of cheap energy. There's plenty of oil out there. There are supposedly 1 trillion barrels of oil shale in the Midwest, Wyoming and Colorado, and now that's different than shale oil. Oil shale is actually shale. It has to be heated, crushed, and then you have to extract the oil from it. Well, Shell, I believe it's Shell and Chevron, they both just abandoned their oil shale projects within the last year and a half.
After working on it for 40 years.
I know. You can't, I think oil shale, its energy return on invested is something like 2 to 1. It's not even, it's so low, and it could be even lower than that. So if no one's making much money, if the companies are barely making money producing shale oil at 5 to 1, then why would you try to produce oil shale at 2 to 1? It's not profitable for anybody. So, let me just say one more thing. I haven't done my update for the second quarter for the silver miners, but of the 12 primary miners in my group, 2/3 of them showed losses so far for the quarter. So only 4 of them made profits. So that just goes to show you the primary miners are still struggling.
All right, that'll be a good place to wrap here. Steve, thanks for joining us today. It's great to have you on the show.
My pleasure.
All right, Steve St. Angelo of the SRSRocco Report. And for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.